Hello, and welcome to the Commonwealth Financial Network February Market Update. My name is Brad McMillan. I'm Commonwealth's Chief Investment Officer. January was a terrible, terrible month for stock markets. You already know that, but it was the worst since January 2009, which tells you something. U.S. markets were down by 5% or more. International markets did even worse. No one's going to look back on January with any pleasure, but the question looking forward is, what does that mean? Why did it happen? Is it likely to get worse? And what should we do about it? Let's start with why it happened. I would argue the answer is one word: confidence. Investors' confidence cracked. We saw another pullback in the Chinese markets. We saw another drop in oil prices. We saw the European political and economic issues start to heat up again. And on top of that, we saw the U.S. economy slow dramatically from the prior quarter, even as the Fed started to take its security blanket away. Any one of those factors could have cracked confidence. And the fact that they all came together means I'm actually a little surprised it wasn't worse. Because looking at this in context, the volatility we're seeing, although scary and not to be minimized, is normal. If you look at the way the valuations adjusted, it's something that typically we see every year or so, and we're overdue. So the question is it going to get worse? Now, I would argue probably not, for a couple of reasons. First of all, for the U.S. market to really go into a bear market, to drop by significantly more than it's done, a couple of factors have to be in play. 80% of the time there has to be a recession. The U.S. economy is not in a recession. Hiring continues very, very strong. Housing continues to go well. Prices are rising, sales are rising, and that reflects consumer confidence in a very profound way. So I don't believe we're in a recession, which takes the major risk factor for a bear market off the table. Second of all, when you see a bear market, you often see commodity price spikes. Commodity prices increase dramatically. We actually have the opposite of that. The same thing applies with interest rates. When the Fed starts raising rates aggressively, we often have a bear market. The Fed's only raised rates once, and this Fed is determined to be part of the solution and not part of the problem. Once again, we have the opposite of that. So with a strong economy and with the factors that lead to a bear market not there, I think it's quite possible we've seen the worst of the damage. Now, that's not to say there's nothing to worry about, and that's not to say we might not see more turbulence. China, for example, is trying to make a very difficult economic transition. But the reality is they have trillions, that's trillions with a T, of dollars and resources to do it, and they have a government with extraordinary powers. Europe continues to struggle, but Europe has been struggling for years, and now at least they have a good sense of the problems and what needs to be done. They're not going to be blindsided. I could make the same points about most of the other things we worry about. And the reality is, right now, most of the major worry factors have been identified and are right into the market. We don't actually need things to go well. We just need things to do a little bit better than we now expect, and that's quite possible. So with that said, I will talk to you next month, and thank you very much for watching.